Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. The concepts discussed regarding divorce insurance and historical financial trends are complex and vary significantly by state and individual circumstances. You should always conduct your own due diligence and consult with a licensed professional before making any major financial decisions or purchasing insurance products. Imagine standing on a street corner in Manhattan in 1924. You are watching the first waves of modern consumerism take hold. If you told a passerby that within a century, half of all marriages would end in a legal dissolution that functions more like a corporate liquidation than a family matter, they would call you a cynic. If you told them that people would one day seek to buy an insurance policy specifically to protect against the financial ruin of a failed romance, they would call you insane. Yet here we are. In the United States today, the average cost of a contested divorce ranges from $15,000 to over $100,000, and that is just the legal fees. It does not account for the split of the 401k, the loss of equity in the family home, or the decades of future earnings potential shifted via alimony. We are looking at a historical shift where the most significant financial risk in a person's life is no longer a house fire or a car accident, but the person sitting across from them at the dinner table. This is the deep dive into why divorce insurance became a logical, if controversial, evolution of the American financial system. By the end of this series, you will understand how we moved from a society where marriage was a permanent economic merger to one where marital risk management is a growing sector of the financial industry. To understand why the concept of divorce insurance, essentially a casualty policy for your heart and your bank account, even exists, we have to travel back 100 years. The financial landscape of the 1920s and 30s was built on the bedrock of the indissoluble union. In that era, marriage was not just a social contract, it was the primary social safety net. If a marriage failed, it wasn't just a personal tragedy, it was a total economic collapse, particularly for women who were largely excluded from the workforce and the credit markets. During this period, the concept of fault dominated the legal system. You couldn't just leave. You had to prove adultery, cruelty, or abandonment. This created a high barrier to entry for the divorce market, keeping the financial risk suppressed because the exit door was locked from the outside. However, as the U.S. transitioned into the post-World War II era, the economic foundations of the American family began to shift. We saw the rise of the middle class and, more importantly, the rise of individual wealth accumulation. When the 1960s and 70s arrived, the legal landscape underwent a seismic shift with the introduction of no-fault divorce laws. Suddenly, the exit door was unlocked. California led the charge in 1969 under Governor Ronald Reagan, and the rest of the country followed. This is where the financial risk spiked. For the first time in American history, an individual could lose half of their accumulated assets without any wrongdoing being proven in court. This created a massive unhedged financial liability for millions of Americans. In the decades that followed, we saw the financial industry scramble to create tools to manage this new reality. First came the prenuptial agreement. Originally reserved for the ultra-wealthy or those with significant inherited estates, the prenup was the first iteration of marital risk management. It served as a private contract to override state laws on community property or equitable distribution. But prenups have a branding problem. They are often viewed as unromantic or a betrayal of the marriage's permanence. They also require both parties to agree at a time when they are most optimistic about their future, which is a psychological hurdle many cannot clear. This brings us to the modern era and the specific problem we face today: the middle-class wealth gap in divorce. While the wealthy have prenups and the poor may have fewer assets to litigate over, the American middle class is uniquely exposed. Their wealth is tied up in illiquid assets like a primary residence, a small business, or a retirement account. When a divorce occurs, these assets often have to be liquidated at the worst possible time, leading to significant taxes and penalties. Case studies of divorce in the 2010s and 2020s show that a household standard of living can drop by 25% to 40% almost overnight. The financial industry looked at this and saw a classic insurable interest. Insurance, at its core, is the transfer of risk from an individual to a larger pool in exchange for a premium. We insure our cars because the cost of a total loss is more than we can easily pay out of pocket. We insure our lives to protect our dependents. So why not insure the marriage? The idea of divorce insurance, often marketed under terms like marital indemnity or safeguard insurance, emerged as a way to provide a cash benefit upon the finalization of a divorce. This isn't about betting against the marriage. From a technical standpoint, it is about recognizing that the legal process of divorce has a quantifiable cost that can be mitigated. Throughout this masterclass, we are going to look at the actuarial data that drives these ideas. We will examine historical trends in marital longevity and how they correlate with economic cycles. For instance, data suggests that during periods of high inflation or housing market volatility, the financial friction of divorce increases, making the idea of an insurance payout more attractive to the average consumer. We will also look at the step-by-step evolution of how a claim would even work. How do you prove a loss in a divorce? Is it the legal fees, the loss of the house, or the emotional distress? We will also explore the moral hazard argument. Critics of divorce insurance argue that if you make divorce less financially painful, you might encourage more of it. However, proponents point to historical case studies in other forms of insurance. Does fire insurance make you more likely to burn down your house? Generally, no, because the emotional and logistical cost of the loss still far outweighs the insurance payout. The goal of this financial evolution isn't to make divorce profitable, but to prevent it from being bankrupting. As we move forward, we will dissect the specific mechanics of the divorce insurance products that have attempted to enter the U.S. market. We will analyze why some succeeded and many failed, often due to the difficulty of predicting human behavior compared to predicting car accidents. We will look at the prepaid legal models which functioned as a precursor to true insurance, providing a fixed amount of legal hours for a monthly fee. This is not just a story about insurance, it is a story about how the American dream evolved to include a Plan B. We are going to look at how the 2008 financial crisis changed the way Gen X and millennials view marital assets, and how the gray divorce trend among baby boomers is creating a brand new set of financial risks that the industry is only now beginning to address. By the end of this series, you will see the concept of divorce insurance not as a strange outlier, but as the inevitable conclusion of a century of economic and legal changes. You will understand how to evaluate your own marital risk, and the historical context that has made the 21st century marriage the most complex financial instrument you will ever sign. Stay with us as we peel back the layers of 100 years of financial history to see where your money and your future really stands. To truly grasp why we are even discussing insurance for a marriage in 2026, we have to look at the massive tectonic shift in how the United States views the family unit as an economic entity. In the early 20th century, a marriage was essentially a closed-loop economy. One person, typically the husband, was the sole breadwinner, while the other managed the domestic sphere. From a risk management perspective, this was a highly concentrated portfolio. If the breadwinner died or became disabled, the entire family economy collapsed. This is why life insurance and disability insurance became the gold standard of financial protection during the industrial age. However, back then, the idea of a voluntary dissolution of that unit was so rare and legally difficult that it simply was not viewed as a manageable financial risk. It was seen as a moral failing or a total social catastrophe, not a line item on a balance sheet. Imagine a couple in 1950. Let us call them Arthur and Eleanor. Arthur works at a manufacturing plant in Ohio, and Eleanor manages the home. Their financial stability is entirely dependent on Arthur's ability to work. If they were to separate, Eleanor would have almost no path to credit, as the Equal Credit Opportunity Act would not pass for another 24 years. In this era, the financial risk of divorce was binary. It was total for the dependent spouse and socially ruinous for the provider. There was no middle ground and therefore no market for a nuanced financial product like divorce insurance. The legal hurdles served as the only insurance policy they had. Fast forward to the transition period of the 1970s and 80s. This is the era where the dual-income household became the American standard. This change fundamentally altered the math of marital risk. Suddenly, you had two separate streams of income feeding into one joint pool of assets. While this increased the overall wealth of the American family, it also complicated the exit strategy. When both parties contribute to a 401k, when both names are on the mortgage, and when both careers are being balanced against one another, the dissolution of that marriage is no longer just a social break. It is a complex corporate demerger. This is where historical trends show a sharp increase in the demand for legal and financial protection. As more assets were put into the marital pot, the cost of dividing those assets grew exponentially. By the 1990s, the average divorce was not just about who got the car or the china. It was about the valuation of stock options, the division of pension plans, and the calculation of future earning capacity. we started to see the emergence of specialized financial planners who did nothing but calculate the long-term impact of divorce settlements. This was the precursor to the insurance mindset. People were beginning to realize that the potential outcomes of a divorce could be as financially devastating as a natural disaster. Take the case study of a typical professional couple in 2026. Let us call them Marcus and Sarah. Marcus is a software engineer and Sarah is a project manager. Together, they earn $250,000 a year. They own a home in a suburb of Austin, Texas, with $300,000 in equity. They have 2 children and a combined retirement savings of $500,000. In the eyes of the law, their marriage is a high-value partnership. If they decide to part ways, the immediate financial friction is immense. They are looking at the potential outcome of selling the home in a volatile interest rate environment, paying 6% in realtor fees, and then each trying to find a new residence at current market rates. The loss of efficiency in going from one household to 2 is often estimated at 30% of their total purchasing power. This leads us to the mathematical birth of the divorce insurance concept. Actuaries began looking at these scenarios and realized that the financial loss associated with divorce is predictable across large populations. While you cannot predict which specific couple will divorce, you can predict with startling accuracy how many couples in a certain demographic will divorce within a certain time frame. Once you have a predictable loss and a measurable financial impact, you have the ingredients for an insurance product. The first real attempt at this in the US was a product often referred to as wedlock. The creators of this product argued that since the average divorce cost around $20,000 in legal fees and resulted in significant immediate wealth loss, a person could pay a monthly premium to build up units of coverage. For example, if you paid $16 a month, you might secure $1,250 of coverage. The longer you stayed married and the more units you bought, the larger the payout would be if the marriage eventually ended. It was designed as a casualty policy. If the casualty, the divorce, occurred, the payout would help cover the legal fees and the cost of setting up a new household. However, this faced immediate cultural and regulatory pushback. In the US, insurance is regulated at the state level, and many state insurance commissioners were wary. They questioned whether this violated public policy by potentially incentivizing divorce. This is a classic example of the tension between financial reality and social ideals. The industry had to prove that the payout was not a windfall, but a partial reimbursement for a documented loss. Just as car insurance does not make you want to crash your car because you still lose your deductible and your time, divorce insurance was never designed to make divorce profitable. It was designed to prevent the total depletion of the middle-class safety net. We also have to consider the data regarding the divorce penalty on retirement. Historical trends show that individuals who divorce after age 50, often called gray divorce, see their wealth drop by 50% or more, and they have significantly less time to recover those losses before retirement. For a woman in this demographic, the potential outcome is often a 45% drop in standard of living. When you look at these numbers, the idea of an insurance hedge starts to look less like a cynical bet and more like responsible estate planning. Step back and look at the broader evolution of risk in America. We have gone from insuring physical objects, ships, houses, crops, to insuring intangible things like professional liability, identity theft, and now potentially our social contracts. This is a reflection of a society where wealth is increasingly tied to our legal status and our relationships, rather than just the gold in our pockets. But there is a major technical hurdle that almost killed the divorce insurance industry before it could truly scale. It is a concept known as adverse selection. In the insurance world, if only the people who know they are going to have an accident buy insurance, the system breaks. For divorce insurance to work, it needs a pool of people who are happily married and intend to stay that way, but want the protection just in case. How do you convince a person on their wedding day to buy a policy for a divorce they do not believe will happen? This hurdle led to the development of even more creative financial structures, some of which are being quietly integrated into other financial products you might already own. As we continue this masterclass, we are going to look at the secret ways marital risk is being priced into your mortgage, your credit score, and even your employment contracts without you even realizing it. The evolution didn't stop with a single insurance policy. It infiltrated the entire American financial architecture. In the next part, we are going to dive into the specific year that changed everything, 2008. We will see how the Great Recession turned the family home from a safe haven into a financial trap, and how that specific crisis forced the first major U.S. insurance carriers to take the idea of divorce coverage seriously. You will see how a plummeting housing market actually provided the blueprint for the modern divorce insurance claim. What happened when millions of Americans found themselves stuck in marriages they couldn't afford to leave? The answer redefined the cost of a broken heart forever. The year 2008 remains a scorched earth period in the American financial consciousness, but its impact on the domestic structure of the United States was far more profound than just a stock market dip. This was the moment the Great Recession transformed the family home from a fortress of stability into a financial anchor that prevented movement, both physically and legally. Before this period, if a couple decided to separate, the standard operating procedure was simple: list the house, split the equity, and move into two separate residences. But when the housing bubble burst, millions of Americans found themselves in a state of negative equity, or being underwater on their mortgages. Imagine a couple in Phoenix, Arizona, in early 2009. Let us call them Brian and Jessica. They bought a home at the peak of the market for $450,000 with a 5% down payment. By the time their marriage hit a breaking point a year later, that same house was valued at $310,000. They owed the bank $425,000 on a property worth nearly $115,000 less than the debt. In the legal world, this created a phenomenon known as the recession-induced marriage. Couples who desperately wanted to divorce were forced to remain living under the same roof because neither could afford to buy out the other, and selling the house meant coming to the closing table with a six-figure check they didn't have. This period provided the first massive data set for what actuaries call marital entrapment risk. This housing trap fundamentally changed the math of divorce. Historical trends from 2008 to 2012 show that while divorce filings actually dipped slightly during the worst of the crash, it wasn't because people were happier. It was because they were broke. The cost of exit had become too high. This is the exact moment when the insurance industry realized that the primary risk in a marriage wasn't just the legal fees, it was the asset volatility. If Brian and Jessica had possessed a form of divorce insurance or a marital equity hedge, that policy could have potentially bridged the gap between their mortgage balance and the fair market value of the home, allowing for a clean break. The lack of such a product during the Great Recession led to a decade of financial scarring. Many couples resorted to short sales or foreclosures just to facilitate a legal separation, destroying their credit scores for 7 years or more. This created a secondary financial crisis: the inability of divorced individuals to re-enter the housing market. Case studies from this era show that the average time it took for a divorced person to return to homeownership after a foreclosure was nearly double that of a married person. The financial industry saw this and began to hypothesize: what if we could treat a divorce like a total loss on a vehicle? In a car accident, if you owe more than the car is worth, gap insurance covers the difference. The concept of divorce insurance began to evolve into a form of gap insurance for the American domestic life. Step by step, the logic moved from the courtroom to the balance sheet. In 2026, we look back at the 2010s as the era of the side hustle and the gig economy, but it was also the era of the diversified household. As the traditional pension disappeared, replaced entirely by the 401k, the risk shifted from the employer to the individual. In a 401k system, the assets are liquid and easily divisible, but they are also subject to market timing. If a divorce occurs during a market downturn, as many did in 2008 and again in 2020, the non-employee spouse is often forced to liquidate their half of the retirement funds at the bottom of the market to pay for immediate living expenses. This results in a permanent loss of compounding interest that can never be recovered. Let us look at the specific data on retirement leakage. Historical trends suggest that for every dollar removed from a retirement account during a midlife divorce, the individual loses approximately $7 in future purchasing power by the age of 65. For an average American with a $100,000 retirement split, that is a $350,000 hit to their future self. This is not just a personal loss. It is a systemic risk to the U.S. social safety net. If millions of divorced individuals arrive at retirement age with depleted accounts, the burden shifts to the state. This realization in the mid-2010s began to shift the conversation around divorce insurance from a niche product to a matter of national economic resilience. By 2015, we saw the rise of the first sophisticated marital risk calculators. These were tools used by high-end financial planners to show clients the potential outcomes of their current asset allocation if a split were to occur. These tools didn't just look at what you owned, they looked at the tax implications of the division. For example, $100,000 in a Roth IRA is worth significantly more than $100,000 in a traditional 401k because of the future tax liability. If a divorce settlement splits these assets down the middle without accounting for the tax drag, One spouse is effectively receiving 20% less than the other. This complexity created a demand for a financial product that could normalize these discrepancies. This leads us to the concept of the transition fund. The early prototypes of divorce insurance in the U.S. market began to focus less on the legal fight and more on the transition period. The most dangerous time for a household's credit is the first 6 months after a separation. This is when double rent, double utilities, and legal retainers hit simultaneously. Case studies show that a significant portion of post-divorce bankruptcies are not caused by the settlement itself, but by the cash flow crisis in the immediate aftermath. A divorce insurance policy designed to provide a lump sum of $25,000 to $50,000 upon the filing of a petition could theoretically act as a shock absorber, preventing the downward spiral into high-interest debt and credit destruction. However, the industry faced a new challenge: the legal definition of a loss. In a house fire, the loss is the damage to the structure. In a divorce, is the loss the end of the marriage? Or is the loss the financial cost of the legal process? If the policy pays out just because you file for divorce, does that create a perverse incentive to file during a temporary argument? To solve this, developers began looking at waiting periods. Much like a suicide clause in a life insurance policy, divorce insurance products were designed with a 2 to 4 year exclusion period. You couldn't buy the policy on Tuesday and file for divorce on Wednesday. This moved the product away from being a tool for people in failing marriages and toward being a long-term safety net for people in healthy ones. This brings us to a fascinating and often overlooked part of the story: the role of the employer. By the late 2010s, major U.S. corporations began to realize that divorce was one of the leading causes of lost productivity and employee turnover. A distracted employee navigating a messy legal battle is an expensive employee. We began to see the first whispers of divorce insurance being offered as a voluntary benefit, right alongside pet insurance and identity theft protection. But as these products moved toward the mainstream, they hit a wall that no one saw coming: the IRS. How do you tax a divorce insurance payout? Is it a tax-free insurance claim? Or is it considered taxable income? The answer to this question would determine whether the industry would flourish or wither. As we move into the next section, we are going to look at the secret tax battles that took place in Washington, D.C. that nearly derailed the entire concept. We will also examine how the rise of artificial intelligence and big data in the early 2020s allowed companies to predict your divorce probability better than your therapist can. If an algorithm can predict a split before the couple even knows it is coming, who is really holding the risk? And more importantly, what happens when the insurance companies start using your social media data to set your premiums? The era of the quantified heart was about to begin. The era of the quantified heart arrived not with a bang, but with a series of quiet updates to the privacy policies of the apps we use every day. By the early 2020s, the intersection of big data and behavioral economics had created a world where financial institutions could analyze marital stability with terrifying precision. To understand the transition toward divorce insurance, we have to examine the data points that insurance companies began to track. Historically, an insurance company would look at your age, your zip code, and perhaps your credit score. But as we moved into the mid-2020s, the metrics became much more granular. Imagine a woman in Chicago named Elena in the year 2026. Elena is a marketing executive who has been married for 8 years. When she applies for a new line of credit or a specialized casualty policy, the algorithms are not just looking at her income. They are looking at what data scientists call life stage transition markers. For instance, historical trends suggest that a sudden change in household spending patterns, a shift in social media engagement, or even a change in the frequency of late-night travel can be precursors to a legal separation. For an insurance provider, this is the holy grail of underwriting. If they can identify these markers before a claim is ever filed, they can adjust premiums or manage risk in real time. This brings us to the controversial role of social media and the digital footprint. In the development of modern marital risk products, companies began to experiment with sentiment analysis. By analyzing public interactions, the frequency of joint photos, and even the linguistic patterns in public posts, AI models could assign a stability score to a couple. If you were a couple that posted frequently about shared financial goals, your risk profile looked different than a couple whose digital lives had become entirely siloed. This transition from static data like a birth certificate to dynamic data like a digital lifestyle meant that the cost of protecting your assets was now tied to your behavior. But the real battle for the future of divorce insurance wasn't just happening in the cloud. It was happening in the tax code. We have to look at the step-by-step evolution of how the IRS viewed these payouts. In a traditional insurance claim such as a fire or a car accident, the payout is generally not considered taxable income because it is intended to make you whole after a loss. It is a return of capital. However, divorce is unique. In the eyes of the U.S. tax code, a divorce is a division of assets, not necessarily a casualty loss. If an insurance company pays you $50,000 when you get divorced, the IRS had to decide if that was a windfall or a reimbursement for the cost of the legal process. Case studies from the early 2020s show that this tax ambiguity was a massive hurdle for the industry. If the payout was taxed as ordinary income, a large portion of the benefit would disappear instantly, making the premiums hard to justify. This led to the development of what we now call legal indemnity structures. Instead of paying the individual directly, some insurance models shifted to paying the service providers. By covering the legal fees, the mediation costs, and the forensic accounting bills directly, the product functioned more like health insurance. This allowed the benefit to remain tax neutral for the policyholder, fundamentally changing the business model from a cash payout to a service-based protection plan. Step by step, this forced the legal profession to adapt. Attorneys who once viewed divorce insurance as a threat began to see it as a source of reliable funding. In a standard contested divorce, one of the biggest risks for a law firm is that the client will run out of money halfway through the litigation, leading to unpaid bills and incomplete cases. With a specialized insurance product in place, the financial friction of the legal process is smoothed out. This created a new ecosystem where insurance companies, law firms, and financial planners were all incentivized to standardize the cost of a divorce. We also need to look at the impact of the pandemic-era housing boom and subsequent cooling on this financial evolution. Between 2020 and 2024, the United States saw the largest increase in home equity in history, followed by one of the sharpest rises in interest rates. For a couple divorcing in 2026, the primary financial challenge isn't just the legal fee. It is the mortgage rate trap. If a couple has a 3% interest rate on their current home, but would face an 8% rate on two separate smaller homes, the cost of divorce is effectively a permanent tax on their future housing. Modern divorce insurance concepts began to incorporate what is known as interest rate differential coverage. This is a highly technical feature where the policy helps subsidize the higher cost of borrowing for the departing spouse, ensuring that a divorce doesn't result in a permanent descent into the renter class. This is where the idea of the marital bridge loan comes into play. In this scenario, imagine a husband named David. David and his spouse are separating, but their wealth is tied up in a family business and a primary residence. Neither wants to sell the business, but David needs liquidity to move out and start a new life. A traditional bank might see David as a high-risk borrower during a divorce. However, a divorce insurance policy with a cash value component acts as a form of collateral. David can draw against the future payout of the policy to fund his transition, using the insurance company as a financial intermediary. This prevented the fire sale of assets that historically destroyed middle-class wealth. The data supports the necessity of these tools. Historical trends in the U.S. show that the first 2 years post-divorce are the most critical for long-term financial survival. According to case studies of thousands of filings, individuals who can maintain their credit score during this transition are 70% more likely to reach their original retirement goals than those who suffer a credit dip. Divorce insurance, in its most advanced form, is essentially credit score insurance for the soul. It provides the liquidity needed to keep all other financial plates spinning, while the legal system grinds through the paperwork. But as these products became more sophisticated, a new ethical dilemma emerged. If an insurance company is using AI to predict your divorce, do they have a duty to warn you? Imagine if your insurance premium suddenly spiked. Would that be the first sign that your marriage is in trouble? We began to see the rise of marital wellness discounts, similar to how health insurance gives you a discount for wearing a fitness tracker. If a couple attended marriage counseling or financial planning workshops, their premiums would drop. This transformed the insurance company from a passive observer of disaster into an active participant in the marriage itself. The implications of this are staggering. We are moving toward a world where the financial industry has a vested interest in the success of your relationship, but a perfectly hedged position in the event of its failure. As we look at the rise of these quantified heart products, we have to ask, who is really in control of the American family's future? Is it the couple, the court system, or the actuaries in a skyscraper in Hartford? In the next part of this deep dive, we are going to look at the dark side of this evolution. We will examine the risk of insurance fraud in the marital world. How do you stop people from faking a separation to trigger a payout? We will also look at the rise of the pre-divorce audit, a new financial service that has become a multi-billion-dollar industry in 2026. This is the part of the story where the numbers meet the reality of human nature, and the results are not always pretty. We will see how a simple insurance policy turned the most private moments of a relationship into a forensic investigation. The loop is opening wider, and the stakes are getting higher. The stakes are getting higher because as the financial industry began to codify the value of a broken marriage, it inadvertently created a new frontier for forensic scrutiny and, inevitably, fraud. In the world of insurance, where there is a payout, there is potential for manipulation. By the mid-2020s, the concept of a pre-divorce audit became a standard procedure for high-value marital insurance claims. This is not just a review of bank statements. It is a deep-dive forensic investigation into the behavior, intent, and timing of the separation. To understand how this works in 2026, imagine a scenario involving a couple in Atlanta. Let us call them Robert and Linda. They have been married for 12 years and have held a specialized marital indemnity policy for 9 of those years. The policy is slated to pay out a significant transition benefit of $75,000 upon the finalization of a divorce decree. When Robert files for divorce, the insurance carrier does not simply cut a check. Instead, they trigger a mandatory audit. The goal of this audit is to determine if the loss is genuine, or if it is a case of strategic filing, designed to trigger a payout during a period of financial hardship unrelated to the marriage itself. Historical trends show that in any insurance market, from disability to fire, claims tend to spike during economic downturns. This is known as the moral hazard of insurance. In the context of divorce insurance, the carrier must ensure that the couple has not entered into a collusive agreement to divorce on paper while maintaining a single household in practice, just to access the insurance capital. This leads to the rise of the marital investigator. These professionals use a step-by-step verification process that includes checking separate residential leases, verifying the division of utility bills, and even monitoring geolocation data to ensure the parties are actually living apart as claimed in their legal filings. The data surrounding insurance fraud in this sector is revealing. In early pilot programs for marital insurance in the late 2010s, carriers noticed a small but significant percentage of claims where the parties reconciled almost immediately after the insurance funds were dispersed. This led to the implementation of the clawback provision. In 2026, many of these policies include a clause stating that if the couple remarries each other within a certain time frame, typically 24 to 36 months, the insurance payout must be returned with interest. This turns the insurance product into a conditional grant, further complicating the financial relationship between the couple and the state. But the forensic investigation goes deeper than just checking addresses. It enters the realm of the pre-divorce audit of assets. One of the primary reasons divorce insurance exists is to mitigate the loss of wealth during the division of property. However, this creates an incentive for one spouse to hide assets or depress the valuation of a business before the policy pays out. In a case study from 2025, a business owner attempted to show a temporary loss in his consulting firm to increase the perceived financial damage of the divorce, hoping to maximize the casualty payout from his insurance provider. The insurance company's forensic accountants used historical trends and industry benchmarks to prove that the business was artificially undervalued, leading to a denial of the claim and a referral for insurance fraud. This level of scrutiny has transformed the most private moments of American life into a set of data points for a corporate claims adjuster. Imagine if every text message, every dinner reservation, and every vacation photo was potentially a piece of evidence used to determine the validity of your insurance claim. We are seeing a transition where the legal system is no longer the sole arbiter of a marriage's end. The insurance carrier's claims department has become a de facto secondary court. If the insurance company refuses to pay because they believe the divorce is a financial maneuver rather than a social reality, it can leave the couple in a worse financial position than if they had never had the policy at all. This brings us to the rise of the professional mediator, who specializes in insurance compliance settlements. By 2026, a new class of professionals has emerged who understand the specific requirements of marital indemnity policies. They work with couples to ensure that their separation agreement is structured in a way that satisfies both the state court and the insurance carrier's audit team. This includes detailed step-by-step documentation of how the insurance payout will be used, whether for legal fees, the down payment on a second home, or the replenishment of a retirement account that was split during the proceedings. Let us look at the data on the cost of these audits. A comprehensive pre-divorce forensic audit can cost between $5,000 and $15,000. In many modern policies, this cost is built into the premium or deducted from the final payout. For the middle-class couple, this means the $50,000 safety net they thought they had might actually be $35,000 after the investigators take their cut. This is the hidden friction of the financialization of marriage. Every layer of protection adds a layer of bureaucracy and cost. Case studies also show the psychological impact of this forensic reality. When a couple knows their behavior is being monitored for insurance compliance, it changes the nature of the separation. In some instances, it actually makes the divorce more contentious. If one spouse believes the other is acting in a way that will jeopardize the insurance payout, it adds a new layer of resentment to an already volatile situation. The financial hedge intended to make the divorce smoother can, in some cases, become the very thing that makes it more toxic. Yet, despite these risks, the demand for these products in the US continues to grow. Why? Because the alternative is the unmitigated financial disaster we discussed in previous parts. For most Americans, the risk of a forensic audit is a small price to pay for the potential outcome of having a liquid cash reserve during the most expensive year of their life. Historical trends in 2026 suggest that as younger generations, who are more comfortable with data sharing and digital monitoring, enter their peak earning years, the resistance to these forensic investigations is fading. They view it as a necessary evil, much like the black box in a car that tracks driving habits in exchange for lower premiums. The evolution of divorce insurance has effectively turned the American marriage into a high-stakes compliance project. You are no longer just staying together for the kids or for love. You are staying together because the actuarial table says it is the most efficient use of your capital, and if you leave, you must be prepared to prove your loss to a panel of experts. This leads us to a disturbing question. If we can insure against the end of a marriage, can we also trade on it? As these insurance products generate massive amounts of data and premium reserves, the financial markets have taken notice. We are beginning to see the first attempts to securitize marital risk. Just as mortgages were bundled into bonds, and life insurance policies are sold to investors in the life settlement market, the American marriage is being prepared for the boardroom. In the next part, we are going to look at the secret world of marital derivatives. We will explore how hedge funds and institutional investors are beginning to look at divorce rates as a tradable asset class. What happens when a stranger in a skyscraper has a financial incentive for your demographic's divorce rate to go up or down? We will examine the potential outcomes of a world where your wedding vows are the underlying asset for a complex financial derivative. The era of the quantified heart is about to get a whole lot colder. The shift from personal protection to institutional speculation is a journey that mirrors the evolution of the mortgage-backed security. To understand how we arrived at the concept of marital derivatives in 2026, we have to look at how Wall Street views risk. In the eyes of an institutional investor, a risk is simply a stream of data that can be modeled, priced, and traded. Once divorce insurance began to accumulate massive pools of premium capital, the next logical step in the financial evolution was to find a way to hedge that capital. This is where the marriage of high finance and domestic law becomes truly surreal. Imagine a hedge fund manager in Manhattan named Julian. Julian's job is not to care about the sanctity of marriage or the emotional toll of a breakup. His job is to look at the massive datasets being generated by insurance carriers and find a way to profit from the volatility. Just as investors use weather derivatives to hedge against a warm winter or a dry summer, the financial markets began to experiment with social stability derivatives. If a major insurance company holds $10 billion in potential divorce claims, they need a way to protect themselves if divorce rates suddenly spike due to an unforeseen economic or social event. They do this by selling that risk to investors like Julian in the form of a derivative contract. Historical trends show that marital stability is often inversely correlated with specific economic indicators like interest rates or the cost of living. In 2026, we see the emergence of what some call divorce bonds. These are essentially cat bonds or catastrophe bonds, but for social structures instead of hurricanes. Investors buy the bonds and receive a high interest rate, as long as the divorce rate within a specific insured pool stays below a certain threshold. If the divorce rate spikes, the investors lose their principal, and that money is used by the insurance company to pay out the surge in claims. This creates a scenario where the retirement funds of millions of people could, theoretically, be tied to the success or failure of marriages in a different part of the country. Let us look at a step-by-step example of how this impacts the average person. Consider a middle-class couple in Seattle. Let us call them Thomas and Claire. They have no idea that their marriage has been digitized, anonymized, and bundled into a social risk pool known as SR 2026 Alpha. This pool contains the risk profiles of 10,000 couples with similar credit scores, education levels, and zip codes. Because they live in a high cost of living area with a high density of dual-income households, their pool is considered high volatility. Investors might bet on the potential outcome that the stress of the Seattle housing market will lead to a higher-than-average claim rate in that pool. This leads to a phenomenon known as the gamification of domestic data. When marriages become underlying assets for derivatives, the demand for real-time data increases exponentially. Institutional investors began to purchase data from dating apps, marriage counseling platforms, and even moving companies to get a leading indicator of where divorce rates were headed. If a high percentage of people in a certain demographic suddenly start using apps designed for single people, that is a sell signal for the marital derivatives tied to that demographic. It is a level of surveillance that turns every swipe and every purchase into a movement on a trading floor. Case studies in the mid-2020s have shown that this can create a strange feedback loop. If the financial markets decide that a certain demographic is likely to divorce, they might pull back on lending to that group or increase the cost of insurance, which in turn creates the very financial stress that leads to divorce. This is the dark side of the quantified heart. The math doesn't just predict the future, it can accidentally engineer it. In the US, where credit access is the lifeblood of the middle class, being flagged as a high divorce risk by a derivative model could have real-world consequences for your ability to get a car loan or a mortgage. Furthermore, we must examine the concept of the life settlement for marriage. In the life insurance world, a person can sell their policy to a third party for a lump sum. The third party pays the premiums and collects the death benefit. In 2026, there are quiet discussions in the financial fringes about marital settlements. Imagine if a couple who was struggling financially could sell the rights to their divorce insurance payout to an investor. The investor would pay the couple a portion of the benefit now to help them stay afloat. But in exchange, if the couple ever does divorce, the investor collects the full insurance payout. This creates a truly perverse incentive where a stranger now has a direct financial interest in your marriage failing. The data surrounding these complex instruments is still emerging, but the historical trends of other derivative markets suggest that once the genie is out of the bottle, there is no going back. The US financial system has always been incredibly efficient at turning any human experience into a tradable commodity. We saw it with life expectancy, we saw it with student debt, and now we are seeing it with the family unit. The goal of these instruments is ostensibly to provide liquidity and stability to the insurance market, making divorce insurance more affordable for everyone. However, the potential outcomes include a world where your most intimate life decisions are being scrutinized by algorithms designed to maximize shareholder value. Step back and consider the impact on the legal system. As these derivatives become more common, the pressure on family courts to standardize and speed up the divorce process increases. If a billion-dollar bond is waiting on a set of divorce decrees to be finalized, the institutional pressure to move those cases through the system can become immense. We are seeing a move toward automated divorce mediation and AI-driven asset division, not just for the convenience of the couple, but for the efficiency of the financial markets that have bet on the outcome. But what happens when the math is wrong? We saw in 2008 what happens when the financial markets fundamentally misunderstand the risk of the assets they are trading. If a major marital derivative product fails because the models didn't account for a sudden shift in social values or a new law that makes divorce harder or easier, the resulting crash could be devastating. It wouldn't just be a banking crisis, it would be a crisis of the American social contract. We are effectively building a secondary economy on top of the family unit, and that economy is only as stable as the marriages it is built upon. The complexity of these products also creates a massive gap in financial literacy. Most couples don't understand their mortgage, let alone a marital derivative tied to their insurance policy. This creates an environment where predatory products can flourish. We are seeing the rise of boutique financial firms that offer to manage your marital risk for a fee, using complex hedging strategies that the average person has no hope of understanding. They use case studies of successful settlements to lure in clients, but the potential outcomes for those who don't read the fine print can be disastrous. As we conclude this part of the deep dive, we have to look at the ultimate destination of this trend. We have moved from marriage as a moral union to an economic partnership to a managed risk to a tradable derivative. But there is one more step in this evolution, and it is the most personal one yet. We are entering the era of the personal IPO for relationships. In the next part, we are going to explore the radical idea of marital equity crowdfunding. What happens when you don't just buy insurance, but you actually sell shares in your future family's earnings to investors in exchange for a debt-free start to your life? We will look at the rise of the relationship equity agreement and how it is replacing the traditional wedding gift. If you think a derivative is cold, wait until you see what happens when your mother-in-law is a majority shareholder in your marriage. The boardroom is officially moving into the bedroom, and the bylaws are being rewritten as we speak. The concept of marital equity crowdfunding and relationship equity agreements, or REAs, represents the final frontier in the financialization of American intimacy. To understand how we reached this point in 2026, we have to look at the massive debt burden carried by the modern U.S. couple. Between student loans, astronomical housing costs, and the rising price of childcare, the traditional starting point for a marriage is no longer zero. It is deeply in the red. This economic reality has birthed a new financial instrument that functions less like a loan and more like a venture capital investment in a startup company. In this case, the startup is the family unit. Imagine a young couple in Boston named Chloe and Tyler. Both are high-achieving professionals, but they are entering their marriage with a combined student debt of $200,000. Under traditional financial models, they would spend the first 15 years of their marriage paying interest to a bank, severely limiting their ability to buy a home or invest in their own future. However, in 2026, they choose a different path. The relationship equity agreement. Instead of a traditional wedding registry where guests buy blenders and towels, Chloe and Tyler launch a private equity offering. Family members, friends, and even accredited outside investors contribute a lump sum of capital, let us say $250,000, in exchange for a small percentage of the couple's future household income over the next 20 years. This is not a loan. There is no interest rate and no fixed monthly payment. It is a share of equity. If Chloe and Tyler become highly successful, the investors see a significant return on their capital. If the couple decides to take lower-paying jobs to focus on public service or raising children, the investors receive less. This model effectively shifts the risk of the American lifestyle from the individuals to a pool of stakeholders. But here is where the concept of divorce insurance becomes the critical fail-safe for the entire system. Because the investors have a vested interest in the couple's future earnings, a divorce represents a catastrophic risk to their investment. Step by step, the legal architecture of an REA requires a sophisticated insurance component. If Chloe and Tyler divorce, their combined household income splits, and their ability to generate the projected returns for their investors is compromised. To protect the shareholders, the REA mandate often includes a required divorce insurance policy. This policy is not for the couple. It is a keyman insurance policy for the partnership. In the event of a legal dissolution, the insurance payout goes directly to the investors to buy out their equity stakes, preventing a messy legal battle where investors might otherwise try to sue for breach of contract or future earnings interference. Historical trends in the mid-2020s show that these agreements are becoming a preferred method for wealth transfer between generations. Instead of a parent giving a child a down payment for a house as a gift, they provide it as an equity investment through an REA. This allows the older generation to maintain a financial connection to the younger generation's success, while providing a structured framework for protection. Case studies of these agreements reveal a startling shift in behavior. Couples with REAs often report higher levels of financial transparency because they are essentially operating under the scrutiny of a board of directors. However, the potential outcomes of this model include a radical loss of domestic privacy. When your marriage is a crowd-funded venture, your financial decisions are no longer purely personal. If Tyler wants to quit his corporate job to start a nonprofit, his investors, which might include his mother-in-law or a group of tech entrepreneurs, may have the right to voice their concerns. The bylaws of the REA might include clauses about maintaining certain debt-to-income ratios, or even requirements for annual financial audits. We are seeing a transition where the marital home is treated with the same forensic rigor as a Silicon Valley tech firm. The data suggests that this model is particularly attractive to the Gen Z demographic, which has shown a historic distrust of traditional debt instruments, but a high comfort level with the gig economy and fractional ownership. In 2026, the rise of specialized platforms that facilitate these agreements has created a secondary market where investors can trade shares in different marital pools. You could, theoretically, own a diversified portfolio of 5% stakes in 20 different high-potential marriages across the United States. This is the ultimate expression of the diversified heart. But let us look at the friction point. What happens to the divorce insurance premium when the investors get involved? Much like a corporation's insurance costs are tied to its risk management practices, a crowd-funded marriage sees its insurance rates fluctuate based on its compliance with the REA's bylaws. If the couple misses a financial reporting deadline or shows signs of household instability, the insurance carrier may hike the premiums, which in turn reduces the dividends paid to the investors. This creates a high-pressure environment where financial stability is enforced by the threat of investor revolt. Consider the case study of a couple in San Francisco who utilized an REA to fund a high-tech farming venture. When the venture faced a downturn, the strain on the marriage became evident through their spending data, which was being monitored by the REA's management platform. The investors, fearing a divorce would trigger the insurance payout and end their long-term upside, actually funded mandatory high-end marriage coaching and a financial restructuring advisor. In this scenario, the financialization of the marriage actually provided the resources to save it, but at the cost of the couple's autonomy. This leads us to the question of legal standing. How does a U.S. family court handle an REA during a divorce? Historical trends in 2026 show that courts are increasingly treating these agreements as enforceable business contracts that sit alongside, rather than beneath, traditional family law. This means that in a divorce, the judge isn't just looking at the best interests of the children or an equitable split of the furniture. They are looking at the fiduciary duty the couple owes to their shareholders. The divorce insurance policy becomes the primary tool used to settle these corporate obligations, allowing the legal system to untangle the human elements while the insurance company handles the institutional ones. We are witnessing the birth of a three-tiered marriage system in America. Tier 1 is the traditional, non-financialized marriage. Tier 2 is the insured marriage, protected by a casualty policy. Tier 3 is the equity-backed marriage, where the couple is the CEO and COO of a crowd-funded entity. Each tier offers a different level of protection and a different level of risk. The potential outcomes for the American economy are significant. As more household wealth is tied to these structured agreements, the volatility of the individual family unit is dampened, but the complexity of the social fabric is increased. As we reach the end of this part, we have to look beyond the numbers and the equity shares. We have to look at the psychological toll of living in a world where your love life has a ticker symbol. What happens to the human spirit when every argument over money is also a potential disclosure event for your investors? We are going to explore the rise of the marital wellness industry, a multi-billion-dollar sector that has emerged specifically to help couples navigate the stress of being a financialized entity. In the next part, we will dive into the role of artificial intelligence as the permanent third party in the modern marriage. We will look at how AI-driven marital assistants are being mandated by insurance companies to monitor household communication and provide real-time conflict resolution. If you thought having your mother-in-law as a shareholder was intense, wait until you see the data on how an algorithm can predict a divorce 3 years before the first argument even happens. The machine is learning how to love, and more importantly, it is learning how to price that love in real time. Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. The concepts discussed regarding AI-driven marital monitoring and insurance risk assessments are theoretical and evolving. You should always conduct your own due diligence and consult with a licensed professional before making any decisions regarding insurance products or marital financial planning. The integration of artificial intelligence into the American household has moved far beyond smart thermostats and voice-activated light bulbs. In 2026, we are witnessing the rise of the algorithmic third party in marriage. For insurance carriers, the greatest challenge has always been the information asymmetry between the insurer and the insured. In simple terms, a couple usually knows their marriage is failing long before they file the paperwork. This created a massive financial risk for insurance companies who might be left holding the bag for a claim that was effectively a foregone conclusion. To solve this, the industry turned to AI-driven marital wellness monitoring as a prerequisite for high-value divorce insurance policies. Imagine a couple in Denver named Samantha and James. When they signed up for their marital indemnity policy, they agreed to a lower premium in exchange for integrating a marital wellness AI into their shared digital ecosystem. This AI does not sit in the corner and record their private conversations. Rather, it monitors the metadata of their digital lives. It analyzes the tone of their text messages, the frequency of their shared calendar events, and even their joint spending habits. Historical trends in behavioral data suggest that a 40% decrease in shared leisure spending combined with an increase in late-night individual digital activity is a highly accurate leading indicator of relational drift. For Samantha and James, the AI acts as a digital smoke detector. If the algorithm detects linguistic patterns associated with high conflict escalation or emotional withdrawal, it doesn't notify the insurance company immediately to cancel the policy. Instead, it triggers a step-by-step intervention protocol. This might begin with a subtle nudge on their phone suggesting a date night or a joint financial planning session. If the patterns persist, the AI may escalate the recommendation to professional counseling. In the eyes of the insurance carrier, this is no different than a commercial building having a sprinkler system. It is a loss mitigation tool designed to prevent a total claim event. The data supporting this is becoming impossible for the financial industry to ignore. Case studies from early 2025 pilot programs showed that couples who utilized AI-driven mediation tools were 30% more likely to resolve financial disputes without escalating to a contested legal battle. For a divorce insurance company, that 30% represents millions of dollars in saved legal fee payouts. Consequently, we are seeing the emergence of premium credits. If your household AI reports a high stability score for 6 consecutive months, your monthly insurance premium might drop by 15%. Your relationship has become a quantifiable risk that you can actively manage through data-driven behavior. But let us look at the granular detail of how this AI monitors the financial health of the marriage. One of the primary predictors of divorce in the United States has historically been financial infidelity, the act of hiding purchases, debt, or accounts from a spouse. In 2026, AI tools integrated with open banking APIs can scan a couple's entire financial footprint in real time. If the algorithm detects a new credit card application or a large cash withdrawal that was not disclosed to the joint financial dashboard, it flags this as a risk event. For the insurance company, this is a red flag for potential outcome, an imminent split. For the couple, it is an opportunity for radical transparency, albeit one forced by a machine. This leads us to a fascinating development in the U.S. legal landscape: the AI-generated marital health report. In some jurisdictions, these reports are now being introduced as evidence in family court. Imagine James and Samantha eventually decide to part ways. During the property division phase, the insurance company's AI provides a comprehensive log of the wellness interventions it attempted. If the data shows that one spouse consistently refused to engage in the recommended mediation or counseling, it may affect the distribution of the insurance payout. The machine is not just a monitor, it is becoming a witness. Step by step, we are seeing the dehumanization of the conflict resolution process. While some find this dystopian, others point to the historical trends of the American legal system, which is often slow, expensive, and emotionally draining. By using AI to identify the financial friction points of a marriage early, the goal is to move away from the high-stakes courtroom drama and toward a more clinical actuarial approach to domestic life. It is the transition from the law of the heart to the law of the spreadsheet. The impact on the insurance market is profound. Because AI can now provide a real-time risk assessment, we are seeing the birth of dynamic pricing for divorce insurance. Much like life insurance for smokers or car insurance for teenagers, the cost of divorce insurance is becoming highly individualized. If you are in a high-stress profession, have a history of financial instability, or refuse to use marital wellness tools, your potential outcomes for a high premium are much greater. This has created a new form of social credit where your ability to maintain a stable, data-verifiable marriage gives you access to better financial products and lower interest rates. Consider the case study of a tech firm in Silicon Valley that began offering marital insurance as part of its executive compensation package. The firm required all participants to use an AI-driven conflict resolution platform. The result was not a lower divorce rate, but a significantly lower cost per divorce. Because the AI had already mapped out the couple's assets and identified their primary points of contention over the course of years, the actual legal process of splitting the estate was reduced from 18 months to 6 weeks. The insurance company was able to pay out the transition benefit quickly, and the employees returned to full productivity much sooner than they would have in a traditional legal battle. However, we must address the potential outcomes of algorithm bias. If an AI is trained on historical trends that favor certain lifestyle choices or cultural norms, it may unfairly penalize couples who do not fit that mold. For instance, a couple that prefers separate finances for cultural reasons might be flagged as high risk by an algorithm that views joint accounts as the gold standard of stability. In 2026, this has led to the rise of the marital data auditor, a new professional role dedicated to ensuring that the algorithms used by insurance companies are fair and transparent. This level of monitoring is also changing how Americans enter into marriages. We are seeing a rise in what is being called the beta test period. Couples are now using marital wellness AI for 2 or 3 years before they even get married, specifically to build up a high stability score that will allow them to qualify for the best insurance and mortgage rates on their wedding day. The data is no longer something that happens to you. It is something you actively cultivate to improve your financial standing. As we reach the conclusion of this section, we see that the century of financial evolution has led us to a place where the marriage is no longer just a contract between two people in the state. It is a high-frequency data stream that is monitored by machines, priced by actuaries, and hedged by investors. We have moved from the era of blind faith to the era of total visibility. But there is one final piece to this puzzle. As the AI becomes more integrated into our lives, it is starting to move beyond just monitoring and intervening. It is starting to predict. In the next part, we will explore the terrifyingly accurate world of predictive marital modeling. We will look at how companies are now able to predict the exact month and year a marriage will end before the couple has even had their first child. And more importantly, we will see how the insurance industry is using this to create the first true zero-risk insurance pool. What happens when the insurance company knows the end is coming before you do? The loop is tightening, and the future is already written in the code. The concept of a zero-risk insurance pool sounds like a mathematical paradox, but in the sophisticated financial landscape of 2026, it has become the ultimate objective for major U.S. carriers. To understand how we reached this point, we must examine the breakthrough in predictive marital modeling. This is the process where historical trends from millions of past divorces are fed into neural networks to identify the subtle, almost invisible precursors to a marital breakdown. We are no longer looking at obvious signs like a missed anniversary or a heated argument. We are looking at microshifts in biometric data, changes in the latency of communication between spouses, and even the predictive power of career trajectory changes. Imagine a man in Philadelphia named Gregory. Gregory has been married to his wife Sarah for 6 years. They have a mortgage, 2 cars, and a comprehensive divorce insurance policy. Gregory believes his marriage is solid, but the predictive model owned by his insurance provider has already flagged his file as yellow. Why? Because the algorithm noticed that Sarah recently started following several high-profile career coaches specializing in solo entrepreneurship, while Gregory's wearable device has shown an 8% increase in cortisol levels during evening hours over the last 3 months. Individually, these are noise. Together, when compared against 10 million case studies of similar demographics, they create a statistically significant probability of a life transition event within the next 24 months. For the insurance industry, this foresight creates the opportunity for a zero-risk pool. If the company knows exactly which marriages are likely to end, they can adjust their reserve requirements and premium structures with surgical precision. They can begin to offload the high-risk policies into the secondary derivative markets we discussed earlier, while keeping the high-stability policies on their own books. This is the step-by-step realization of a fully priced human experience. In this environment, the insurance company is essentially a time traveler, looking at the probable end of your marriage before you have even felt the first spark of doubt. This predictive power introduces a new ethical and financial dilemma: the preemptive rate adjustment. In 2026, some experimental policy structures allow carriers to raise premiums based on predictive risk rather than actual events. If Gregory and Sarah's marital stability score drops below a certain threshold, their monthly premium might increase to reflect the higher probability of a payout. This is the ultimate feedback loop. The increased financial pressure of the higher premium could, in itself, become a contributing factor to the stress that leads to the divorce. It is a case study in how the observation of a phenomenon can fundamentally change the outcome of that phenomenon. Furthermore, we are seeing the rise of the divorce prevention rebate. In an effort to keep their pools profitable, insurance companies have begun to offer significant financial incentives for couples who undergo what is known as radical transparency auditing. This involves a quarterly deep dive into every aspect of the couple's shared life, from their health data to their search history. The goal is to identify and fix the structural weaknesses in the marriage before they become terminal. Historical trends show that marriages that survive a crisis often become more resilient, and therefore less risky for the insurer. By funding the repair of a marriage, the insurance company is essentially protecting its own capital. Let us look at the data on the accuracy of these models. In a 2025 white paper released by a leading U.S. actuarial firm, It was found that predictive modeling could forecast the dissolution of a dual-income household with 85% accuracy within a 6-month window. This level of precision has turned the divorce insurance industry on its head. It has moved from a casualty model, where you insure against an accident, to a life cycle model, where you are essentially prepaying for an inevitable transition. This shift has profound implications for how Americans view the permanence of their vows. If a machine tells you there is an 85% chance you will be single in 2 years, how does that affect your willingness to invest in a 30-year mortgage with your partner? The psychological impact of this predictive reality is creating a new phenomenon in the US: the marital pre-settlement. Because the data is so clear, many couples in 2026 are choosing to negotiate their divorce settlements while they are still happily married. They use the insurance company's AI to create a fair and equitable division of assets based on their current trajectory. This document sits in a digital vault, ready to be executed the moment the predictive model hits a certain threshold. It removes the element of surprise and the emotional volatility of a sudden breakup, turning the end of a marriage into a pre-planned corporate dissolution. Consider the case study of a high-net-worth couple in New York. They utilized a predictive-led insurance policy to manage their complex estate. When the AI flagged a high-risk period during their transition to retirement, the couple didn't panic. They looked at the data, saw the specific friction points, largely related to a lack of shared hobbies and differing views on downsizing their home, and used their insurance-funded wellness credit to hire a specialized transition consultant. They managed to beat the odds and stay together, but only because they treated their marriage as a risk-managed asset. Step by step, we are seeing the end of the traditional divorce lawyer as the primary actor in this space. In their place is the risk mitigation officer. These professionals work for the insurance companies and the couples simultaneously, using data to navigate the complexities of modern life. They are less interested in who is at fault and more interested in how to preserve the total value of the marital estate. The potential outcomes of this shift include a more stable middle class, but one that is increasingly managed by external algorithms and financial structures. But what happens to the 15% that the models miss? The outliers, the couples who defy the data, and the sudden, unpredictable shocks to a relationship that no machine can see? This is the final frontier of marital risk. As the majority of the population moves into these managed, predictive insurance pools, those who remain outside the system, the uninsurable or those who refuse to be monitored, face a brand new kind of financial isolation. They become the high-risk outliers in an economy that prizes predictability above all else. We have traced a century of evolution from the early 1900s to the predictive code of 2026. We have seen marriage transform from a moral covenant to a managed financial derivative. But there is one final question that remains. In a world where every risk is priced, every loss is hedged, and every breakup is predicted, what is the true cost of a life without risk? Are we protecting the American family? Or are we just ensuring that the financial institutions always come out ahead, regardless of whether we stay together or fall apart? In the 10th and final part of this masterclass, we are going to look at the ultimate conclusion of this century-long journey. We will examine the sovereign household and the rise of the autonomous marital trust. This is where the insurance policy becomes the foundation of a brand new legal entity that exists outside of traditional state control. We will see how the super wealthy and the tech elite are using these tools to create family dynasties that are literally divorce-proof. The final loop is about to close, and the result will change how you think about your money, your partner, and your freedom forever. Stay with us for the finale. Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. The concepts discussed regarding autonomous marital trusts, sovereign households, and the future of insurance are theoretical and based on emerging trends in 2026. State laws regarding trusts and marital property vary significantly. You should always conduct your own due diligence and consult with a licensed attorney or financial advisor before implementing complex asset protection strategies. We have arrived at the ultimate destination of this century-long journey. We have seen marriage transform from a simple social bond into a complex financial instrument, a tradable derivative, and a data-driven risk pool. Now, in the final act of this evolution, we are witnessing the rise of the sovereign household. This is where the elite and the technologically savvy are moving beyond simple insurance policies and into the realm of the autonomous marital trust. This is a specialized legal entity designed to exist independently of the individuals within it, effectively making the family unit divorce-proof by removing the concept of personal ownership entirely. Imagine a couple in Silicon Valley named Leo and Maya. In 2026, they do not simply get married under the laws of the state of California. Instead, they form a sovereign household trust. This trust, governed by a set of smart contracts and overseen by an institutional fiduciary, becomes the legal owner of every asset they acquire. Their home, their venture capital interests, their intellectual property, and even their future earnings are titled to the trust. Leo and Maya are merely the beneficiaries and managers. Because the trust owns the assets, and the trust has no heart to break and no ego to bruise, the financial destruction usually associated with a legal split is theoretically neutralized. Historical trends show that the ultra-wealthy have used similar structures for generations to preserve dynastic wealth. However, the innovation in 2026 is the democratization of these tools through technology and specialized insurance products. To make a sovereign household work for the middle class, it requires a unique form of contingency insurance. This insurance doesn't pay out upon divorce. It funds the ongoing administration of the trust if the managers, the couple, decide to live in separate residences. It allows for the household to split socially without splitting financially. This is the step-by-step realization of the corporate marriage. Let us look at a case study of how this functions during a transition. Suppose Leo and Maya decide to separate after 15 years. In a traditional 20th century model, they would spend years in court fighting over the valuation of their tech startup and the equity in their home. In the sovereign household model, nothing changes at the ownership level. The trust continues to hold the assets. The insurance policy they have been paying into for over a decade now activates to cover the cost of a second residence for Maya, while Leo remains in the primary home. Their combined income continues to flow into the trust, which then distributes pre-agreed stipends to each party based on the original bylaws. The potential outcome is a total preservation of wealth and a seamless transition for their children, who remain the ultimate beneficiaries of the trust's growth. This represents a radical departure from the last 100 years of U.S. family law. We are moving toward a world where the financialized marriage is essentially an indestructible corporation. The data suggests that this model is gaining traction among high-income earners who view the traditional legal system as an unnecessary tax on their life's work. By using insurance as the lubricant for this complex machine, they are bypassing the emotional volatility of the courtroom. The insurance company acts as the auditor of the trust, ensuring that both parties adhere to the financial bylaws they agreed upon when they were most aligned. Step by step, this creates a new class of household, the resilient entity. In 2026, these entities are becoming the preferred borrowers for banks. A sovereign household trust with a decade of positive data and a robust insurance backstop is a much safer bet for a 30-year mortgage than two individuals whose partnership could dissolve at any moment. We are seeing a future where your credit score is no longer tied to your name, but to the stability and insurance rating of your household trust. This is the ultimate expression of the quantified heart, where your social stability is converted into a superior financial standing. But what does this mean for the concept of freedom? The potential outcomes of this evolution are double-edged. On one hand, you have total financial security and the preservation of multi-generational wealth. On the other, you are bound by the bylaws of a contract that may have been written 20 years ago. The insurance company and the trust smart contracts effectively become the governors of your life. If you want to make a radical change that threatens the trust's stability, the insurance premiums might skyrocket, or the trust might withhold distributions. You are safe, but you are also managed. As we look back at the century of evolution, the through line is clear. The American financial system has spent 100 years trying to solve the problem of human unpredictability. From the first fault-based divorces to the AI-monitored sovereign trusts of 2026, the goal has been to turn the messy, emotional reality of love into a predictable, insurable, and tradable asset. We have succeeded in making marriage a safer financial bet, but in doing so, we have changed the fundamental nature of the union. It is no longer just a promise between two people. It is a multi-stakeholder enterprise involving insurers, actuaries, algorithms, and investors. Historical trends in the U.S. suggest that once a financial innovation takes root in the elite classes, it eventually trickles down to the general public. In the coming decade, the idea of a marriage without a specialized insurance policy or a structured risk management trust will likely seem as reckless as driving a car without a seatbelt. We are entering an era where financial literacy will be the most important skill in a successful relationship. You will need to understand your policy's exclusion clauses, as well as you understand your partner's love language. Consider the final case study of this masterclass. A couple in 2026, getting married in a small ceremony in Virginia. They exchange rings, but they also exchange digital keys to their shared indemnity vault. They have a pre-funded transition account, a marital wellness AI monitoring their communication, and a sovereign trust that holds their future. They are the most protected generation in history. They have successfully hedged against the financial ruin that destroyed their parents' generation. They have looked the statistics of the last century in the eye and said, "We will not be a data point of failure." This deep dive has shown us that the idea of divorce insurance was never a joke or a niche product. It was the inevitable conclusion of a society that prizes individual wealth and asset protection above all else. As we move into the second half of the 2020s, the question is no longer whether you should insure your marriage, but how you will manage the massive amount of data and capital that your marriage now represents. The boardroom has replaced the chapel, and the actuary has replaced the priest. Thank you for joining us on this 10-part masterclass through a century of financial evolution. You now possess a deep understanding of the forces that have reshaped the American home. As you look at your own finances and your own relationships, ask yourself, are you a managed risk? Or are you still living in the era of blind faith? The tools of 2026 are here, and the future of your wealth depends on how you choose to use them. The era of the quantified heart is only the beginning. As we look toward 2030, a new question is emerging. If we can insure our marriages, what happens when we start to insure our friendships, our professional reputations, and our very identities? The loop of financialization is never truly closed. It only expands. Stay tuned for our next deep dive, where we explore the rise of the social reputation bond and the end of personal anonymity in the U.S. economy. The stakes are about to get even higher.